Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Dollarama are seeing some pressure today. That's after the discount retailer posted same-store sales in its latest quarter that came in below estimates. Dollarama says unfavorable weather conditions negatively impacted store traffic. On the upside, it beat profit and revenue expectations and boosted its dividend. Shares of GoEasy are trading higher today, about 2.8% right now. The Canadian firm has won concessions from its lenders to keep key funding lines open amidst weakness in its auto lending business. That unit saw a surge in loan losses. GoEasy is also delaying its earnings report. Earlier this month, it suspended its dividend, withdrew guidance, and disclosed about $331 million in charge-offs and write-downs for the fourth quarter. Shares of Boralex are getting a boost today. They're up almost 9% after the renewable energy firm confirmed it is conducting a strategic review of the company. Bloomberg is also reporting that the options could include the company going private. Boralex has a market value of about $3 billion and has a number of projects in development. It builds and operates renewable energy production sites in North America and Europe. And taking a look at the markets right now, the TSX has kind of turned around. Started off down, but a little bit of a bounce back right now. A lot of uncertainty, a lot of volatility. TSX up right now and above 32,000. And in the U.S., you can see it's a mixed bag. People trying to figure out where they should go, what they should do after that rally yesterday. S&P 500, it's a wash right now. The Dow up by about 0.15, and the Nasdaq's off by a half point. And the uncertainty around the war in Iran continues to impact markets and oil prices. My next guest believes the current oil shock could put global economies under severe risk. Let's take a closer look with Martin Pelchier, Senior Portfolio Manager at Trivest Wealth Counsel. Martin, thanks very much for joining us.
You betcha. Thanks for having me.
I mean, I think just looking at the markets today, everybody is kind of flipping coins, it feels like right now, trying to figure out where to go.
Yeah, there's going to be a lot of uncertainty until we get some sort of clarity at what's happening in the Middle East. This higher oil price, it's important to make a distinction between a supply shock versus a demand-driven rally, and understanding how that triggers and works its way into the market and how that impacts risk assets and non-risk assets. And once you get your head around that, it really tells you a lot about the positioning and how we're seeing these moves happen on a daily basis.
I mean, we're seeing oil again today. The fear is back that the war may escalate, and oil's not jumping, but still 3% today.
Yeah, so we're in a supply-driven shock, and during these episodes, typically oil and the U.S. dollar rallies together. And when you see a demand-driven oil rally, you see oil rally and U.S. dollar fall. And we're not in that scenario. And as a result, it creates a dislocation, and people don't want to be buying long duration assets. So, for example, longer term bonds have done poorly. Longer duration stocks like tech stocks have done poorly. And even gold has sold off on the US dollar rally here. I think the catalyst was last week's Fed FOMC. And they certainly didn't act appropriately, in my opinion, given the demand impact this is going to have. That could send the U.S. into a recession, certainly move it towards stagflation. And other central banks are going to have to take cue from that.
Would you like to have seen them be a little more dovish then?
Yeah, they absolutely should have. If you take a look at the previous supply shocks, 1990 Gulf War, the Federal Reserve actually eased their policy during that energy spike because growth was weakening. Also in 2007, they did the same thing. If you look where we are today and you do the impact of current oil prices on consumers, especially in the U.S. and gasoline prices, working with my good friends down south, Gas Buddy, $300 to $350 million a day is the economic impact on the working class in the U.S. And that's equivalent to a 50 basis point rate hike. And so if you look at the FOMC minutes last week, on the dot plots, they became a little bit more hawkish when they should have been dovish. And I mean, the Fed and central banks tend to be reactionary instead of proactive. And that you can see any sort of risk assets sold off hard on that FOMC, including gold sold off, which isn't a risk asset. It's perceived to be a safety asset, but that in particular is tied to the U.S. dollar, and then the U.S. dollar went higher. So that FOMC really threw a wrench into the market last week.
All right, I want to get to some of your picks, but I want to ask first about, you mentioned about stagflation, possible global recession. How close do you feel we are right now? Do we still have some wiggle room?
We do have some room, but if we're still facing the same kind of situation we are in 30 days from now, it's not going to be pretty, and central banks are going to have to be proactive here. You look at a lot of major feedstocks, fertilizers, sulfur. This isn't just oil. And how that's triggering in, rising commodity prices in certain segments of the commodity market, and economies that are weakening or fragile. At the same time, you have governments running big fiscal deficits and don't have a lot of dry powder. And central banks are going to have to start printing to substantiate this and try to stimulate growth. So yes, if and I think oil stocks are telling you that, and other segments that are tied to the potential benefits of higher commodities are saying, looking longer term, the demand weakness is going to be quite pronounced. So we have to get this under control in the Middle East, or some sort of visibility towards an off-ramp for the U.S., but it's looking like it's more of an on-ramp for Saudi and UAE and others coming into the conflict.
Okay, well, let's get to some stocks you're looking at, maybe take advantage of the situation. AEM and BHP, we'll kind of put those two together.
Yeah, and I've been on your show and I've recommended them. And AEM's off 20 to 30% from its highs. And so it's a levered way of playing gold, although it has a super clean balance sheet and cash in the books, but and generating a significant amount of cash flow. It is a levered way of playing gold, and gold's off almost 20% from its highs. And the reason being, again, is the Fed and the higher dollar and a hawkish outlook is not good for gold as a commodity. In addition to countries being worried about selling off or raising some capital, and gold has done well for them, so they've been selling some gold as well. Potentially, there's no verification of that, but that does make some sense. So I think when eventually this conflict does get resolved, and there's tremendous pressure for it to happen, that gold and gold-related producers are going to do very well. Now, if you'd missed out on the rally, here's a second chance. They don't come around very often.
All right, and then BHP?
Yeah, copper's been really hit on the economic outlook. BHP's probably the best, in my opinion, or our opinion here at Trivest, that it's the best copper producer out there. Does have some exposure to the fertilizer space, and it's off 22% from its highs. We think the AI build-out is not under risk unless the feedstock costs continue to escalate and we stay at this stagflationary environment. And also a big source of funding for those AI build-up comes from the Middle East and from countries in the Middle East. So as soon as we get some stability there, we're going to see a resumption in that AI build-out, and that means a resumption in demand for copper. In the meantime, inventories and supply is going to get impacted by this drop in price. So that'll set up a nice recovery here for BHP. And again, if you missed out on that rally, there's a second chance here, in my opinion.
All right, and those are the ones that you're adding to your positions on, and you're starting to add a position with NTR, with Nutrien.
Yeah, looking at the fertilizer, 2005 was a bumper crop, and farmers are going to need to add nutrients back into the ground. The feedstock costs are tremendous. And nitrogen and sulfur have been impacted by the Strait of Hormuz, and as a result, there's some concerns about how that's going to impact demand. However, longer term, when you're driving a car or a race car, you want to look where you're going, not in over the hood. And if you look where you're going, demand for fertilizers and phosphates, nitrogen, and related are going to go up, and they're going to be quite strong. And those stocks have performed, okay. I mean, they're having a good day today, but we've been adding to Nutrien on each of the dips that have been happening.
All right, we have to wrap it up there. But just one last note, you're holding your oil position as well. Martin, thanks very much for joining us.
You betcha. Take care.
Martin Palchier is Senior Portfolio Manager at Trivest Wealth Counsel. Coming up, shares of Estee Lauder are under pressure today after the company said it's in talks to buy Spanish fashion and beauty company Puig. Stay with us. Shares of Estee Lauder are trading lower today after the company said it is in talks regarding a potential merger with Spanish beauty and fashion company Puig. Shares of Puig have risen sharply. Let's get more now from Oliver Chen, Managing Director, Senior Equity Research Analyst at TD Cowen. Oliver, thanks very much for joining us.
Roger, it's a pleasure to be here.
All right, this is a pretty big deal, I guess, within the cosmetics makeup industry. What do you like about it? What are some of the positives to this?
Yeah, the story here is Estee Lauder gaining access to a bigger fragrance business and adding more fragrance to their portfolio. So it's a good deal on paper. However, execution matters a lot in terms of integration, culture, the way these companies work. That's a big unknown. Furthermore, it's noteworthy that Estee Lauder is still in a process of recovery. The margins are lower at about 15% versus 20% and higher in the past. And also, it's losing share in some areas. So Estee Lauder's undergoing a renovation itself, and we'll see about this deal. But on paper, it's a good deal because it gives Estee Lauder a bigger footprint in fragrances. Fragrances have been a very successful category, as we forecasted at TD Cowen to grow mid to high single digits or more. Furthermore, the target Puig has a very nice portfolio of iconic fragrances, including Caroline Herrera, Rabanne, and others. So those are big positives for the industry in terms of the fragrance business and also the nature of what they'd be getting. Puig valuation has been lesser in terms of the IPO and what's happened with Puig over time. So it's a good value as well with that valuation. Otherwise, Estee Lauder may have to do several small M&A deals to achieve what's possible. But the devil's really in the details, and it's about almost hiring a DJ before you have a venue or wiring.
I love that reference in your notes. Has Estee Lauder ever done anything like this, anything this big?
No, it's one of the biggest deals. Earlier in the history of the company, there's been Tom Ford deal and smaller deals as well. And integration has been a consideration for Estee Lauder, meaning it's not always been easy for this company to integrate some of the brands. So that's something analysts and I'm watching too for what it means. It takes a lot of people and marketing and skills. We also have a lot happening in the beauty industry, meaning TikTokification, Amazonification, the continued new channels at which consumers are shopping. So that's part of the story, which makes it quite dynamic. Another element is competing against big heavyweights such as L'Oreal, and that's part of what these companies are looking to do. As we look ahead, Puig is also developing some skincare. So Estee Lauder is iconic for La Mer, advanced night repair, skincare. That's a potential synergy to Puig too. And there are synergies like sharing research and development, centralized cost as well. And also Puig has done a very good job executing on global campaigns with the right amount of drama too.
And the culture, potential culture clashes, what might be issues with that? I'm looking, the family has 90% of the voting rights that's involved with Puig. And could that be an issue at all, do you think?
Yeah, it's always a consideration. You know, you really have to get that piece right because these brands are about humanity and managing them for the long term. What's good about Puig, as we see it, is their iconic portfolio of brands has been very stable, and the family has been committed. That being said, any deal that happens, needs to have that compatibility, especially because this is a unique Spanish-based company with a long family heritage. But perhaps it too can be better combined and they see opportunities. But partnership and leadership, that's a big part. It looks great on paper and it's probably accretive. However, this will not work if the compatibility isn't there with the power structure as well.
And where are the growth opportunities with this?
Well, fragrances in terms of what's happening there globally. Also, skincare in terms of Estee Lauder bringing skincare capabilities to Puig as well.
And but I mean, beyond, like, obviously acquiring the company, but where would potential opportunities lie expanding the fragrances or bringing them to new markets?
Yeah, you know what the footprint becomes more sophisticated. Estee Lauder has some nice strongholds in Asia and travel retail as well. Puig has some very good strongholds in Europe. So globally, it's a good picture as well. Puig has done a good job launching in some specialty wholesale channels. That's another area which is quite healthy for both players. Travel retail, and Puig has done a good job with brands like Byredo and others on direct to consumer. So I think those are all channels where the modern beauty shopper is shopping. Both of them need to face the challenge of Amazon and what to do there. Estee Lauder has partnerships with Amazon, so there's learnings there as well. And both of them have relationships with Sephora, which is owned by LVMH. So it's synergistic in terms of these opportunities across the channel, and they'll have to modernize together. Estee Lauder is a work in progress in terms of becoming more digitally enabled and driving more loyalty and younger customers. Puig has a very nice portfolio of brands within masstige and premium mass, which is quite appealing to younger customers as well.
And you mentioned about digital. Just curious, how does AI come into play in a sector like this?
Yeah, we're thrilled about AI. I teach a class at Columbia Business School on AI as well, but AI is coming through the consumer experience in terms of conversational commerce and personalization. AI is also a real unlock for the logic of retail and supply chain and inventory management and getting the right stuff to the right place at the right time. Beauty's also done a great job historically with augmented reality, meaning really seeing your face and understanding changes you can make with color and lipstick and makeup. And that's part of the AI magic as well. But beauty can be complicated yet very, very fun. And part of that personalization aspect is what AI can do very well in terms of helping you discover things that are personal to you, that you need but you didn't know you needed, and also like enhancing your look across skincare. And sometimes these models can horrify you in terms of what they recommend or what you need to do, but that can also help with engagement and solve problems too when you think about skincare. Skincare is worth speaking about because Estee Lauder has a stronghold in skincare. And skincare is a hard industry to crack because it requires so much loyalty. So that's something on a combined basis that Puig could benefit from. And there's a lot happening in the world of skincare with medicalization and efficacy and diagnosis and sun care that will be a continued of interest to all consumers as that category evolves too.
All right, we have to wrap it up there, Oliver, but thanks very much for joining us.
Pleasure to be with you. Thank you.
Cheers. Oliver Chen, Managing Director, Senior Equity Research Analyst at TD Cowen. Coming up, today's market drivers with Bloomberg's Monique Molima. We'll dig into Dollarama's latest earnings results. Time to take a look at today's market movers. We're joined by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us.
Of course, thanks for having me.
All right, let's start off with Dollarama coming up $1 or so short.
Yes, so Dollarama, their shares are down today after their fourth quarter results disappointed analysts and investors. The comparable sales were less than expected for the quarter, and Dollarama says that some of this was due to poor weather, leading to less foot traffic in stores and less customers buying things. But we've also seen from the quarter, analysts point out that there was some weakness on the Canadian comparable store sales, while there was some growth in Australia. The company also gave some outlooks for the coming year. shares. And analysts note that these outlooks seem to be a bit conservative, which is raising some questions around whether we're going to continue to see some pressure on the sales growth going forward. So that's why we're really seeing the decline in shares today.
Okay, Venture Global, they're going to be busy for the next little while, aren't they?
Yes, so this is a U.S. liquefied natural gas company, and their shares are rising today as the pressures in the Middle East and the conflict there are really tightening the supply of LNG globally. Qatar has had some of their energy assets hit, as well as Iran. And due to that kind of constraint in the market, that means that investors and buyers are going to have to turn to other supplies. And Venture Global could be one of those ones that they are turning to. Analysts note, too, that they are also uniquely positioned to benefit from this because they have a lot of exposure to spot prices in terms of gas. Some companies have contracted a lot of their gas far in advance, so they don't see a lot of movements on the day-to-day prices. But because Venture Global doesn't have that to the same extent, when prices go up, they're able to more quickly benefit from that. And as we've seen gas prices rising, they're expected to see their stock continue to rise too.
Okay, and TransAlta getting a bump.
Yes, so TransAlta, their shares are higher today after National Bank upgraded the stock. They see the stock as more attractively valued now after some of the recent declines that it's seen. And they note, too, that there's a lot of growth on the horizon for the company. It could see double-digit growth through 2029. The company's looking to add more power onto its load, and that's going to help it really also capitalize on some of these higher power prices that we're seeing in the markets right now. They're going to be expanding in Alberta, and they're also looking to get into more of the data center space. That's been a really growing area in electricity right now, and natural gas as well, with the demand that these AI data centers have. And the company is working on a deal with CPP in Brookfield to expand its data center operations in Canada. And analysts really see these as kind of positive for the growth outlook for the company.
All right, we'll wrap it up there. Monique, thanks as always. Bloomberg's Monique Malima. Coming up, oil is climbing after Iran ruled out direct talks with Washington to help resolve the Middle East conflict. After the break, we'll dig into what that means for the broader market. That's next. Shares of GoEasy are trading higher today, up about 4%. The Canadian firm has won concessions from its lenders to keep key funding lines open amidst weakness in its auto lending business. That unit saw a surge in loan losses. GoEasy is also delaying its earnings report. Earlier this month, it suspended its dividend, withdrew guidance, and disclosed about $331 million in charge-offs and write-downs for the fourth quarter. Agricultural land prices continued to climb across the country last year. Some regions, though, did better than others. According to a report by Farm Credit Canada, farmland values rose more than 9% in 2025, extending a three-decade upward trend. The federal corporation says the market was supported by farmland's long-term investment appeal, tight supply, and strong competition. Shares of Uber are trading lower. There are reports the ride-share giant is in talks to acquire German startup Blacklane, a premium chauffeur service provider. According to the reports, the deal is close to being finalized, and the valuation could likely be in the high three-digit million euro range. Earlier this month, Uber launched a new chauffeur ride option called Uber Elite, targeting corporate and executive travelers. And looking at the markets right now, the TSX having a good second day. After starting the day in the red, it's up about 0.7%. South of the border, it's mixed. You can see the S&P 500 pretty much kind of hovering around flat. Dow Jones up by 0.34%, and the NASDAQ is off by 0.3. It's improved. It was off by a half point about a half hour earlier. And oil edging higher this morning as well, climbing after Tehran ruled out direct talks with Washington to help resolve the Middle East conflict. The rebound follows Monday's sharp sell-off. So what does this mean for the broader market? We got perspective from Scott Kronertz, head of U.S. equity strategy at Citi.
The broadening argument really was a function of sort of a Goldilocks economic backdrop where you have soft landing economic conditions and an easier Fed. And that what was intended to promote, I think, a broadening in terms of earnings growth across different sectors and even down into U.S. small mid-cap. What's happened with the backup in oil prices as a function of the Iran conflict is that you've begun to bring into question some of the premise for that broadening playbook.
We've been looking throughout the last couple of days and weeks in terms of how this price of oil is really going to affect basically everything. When it comes to the next earnings season, how do you think the price of oil will affect things there?
Well, the way we think it plays out here is over the next month or so, we have to continue to work through the Iran conflict itself, and we're watching the oil futures curve pretty closely on this. But what we think happens as we go into the Q1 reporting period is that we'll probably get another set of solid earnings results, much like we saw with Q4 reports. But the difference this time is we would expect that most corporates will be a little bit cautionary in terms of their outlook as a function of the uncertainty that's kind of unfolding on the backs of the Iran conflict and higher oil prices.
And you talk about that uncertainty, like now we're seeing, as we mentioned in the lead into Tehran denying that it's had any talks with the U.S., despite Donald Trump saying that talks have been happening between the U.S. and Iran. Like, is that an added layer of uncertainty for investors, or does it really come down to prices?
Well, I think as we've been going through this for the past almost 4 weeks now, I mean, the news flow, obviously in and of itself, is fairly uncertain, if you will. But I think what we're really focused on here is duration of conflict, and then therefore the duration of the spike in oil prices and the degree to which oil prices remain higher for longer and then relative to previous expectations. And it's that relative to previous expectations that really matters. So we expect that we're going to go back and forth. It's very hard to predict the actual timing on this, and I think most investors are in that same camp. So where we're focused on is my point here is that we went into this year looking for an oil price deck, probably on WTI in the mid-60s, and now we're looking at a futures curve that takes it in roughly $10 higher. So what that does is begin to feed through sort of the inflation mechanism, the product pricing mechanism, and we think ends up having sort of an overhang issue on an otherwise fairly healthy consumption picture.
There are other factors, though, that you've highlighted apart from the Iran conflict that might be affecting markets, that might be affecting earnings season when it comes around again. So you mentioned private credit uncertainty, AI disruption, and funding concerns. Are any of those three a standout to you, or do you want to go through all of them and how they might affect things going forward?
It's a long list, right?
Yeah.
So I'd say the Iran conflict and oil is most topical right now. We kind of argue that has almost sort of a black swan potential there if this does persist for much longer. The private credit issue is more of a tail risk that we think is more or less contained, but we do need to factor it into our outlook. And then the AI disruption narrative, which was front and center just a month or so ago, is still out there, but that's a longer term issue. So we go back and forth on the AI playbook in terms of a productivity positive relative to a disruptive negative, and that's going to play out, I think, with different puts and takes. The tariff discussion is still in the background. That is less resolved as the Supreme Court overruled some of the IEEPA tariffs. So what my point here is that we've got a series of issues that have not really been resolved, and we expect that as we go through this next 1 to 3 month time frame, we should begin to get a little bit more comfort that we have a better line of sight to how those unfold. So in the meantime, the high level takeaway here is that expect uncertainty to prevail. We think it manifests in the Q1 reporting period, and it kind of keeps us a bit more focused on the risk elements of U.S. equities right now relative to the reward that we might see coming out the other side of some of these.
With that in mind, are there any sectors that you think could still outperform through all of this, or sectors that maybe investors in the meantime, as you say, could go to as almost a safe haven?
Yeah, we've been arguing the U.S. as a relative safe haven versus rest of the world. And then within that, it's the mega cap growth tech cohort that we think is sort of arm's length from certainly the oil price issue. The fundamentals here, I think, are fairly visible around the AI build-out storyline, and we've seen that in terms of the earnings revisions, particularly on the semiconductor space. And in the case of software, which got a lot of negative press earlier this year, we think that's been finding bottom with a lot of the terminal multiple issue now priced in. So where we're going with this is U.S. Sort of, we think is set up better than the rest of the world right now. And then within that, it's this mega cap growth tech component of the market that we think can be a little bit more of a relative safe haven as we navigate some of the more apparent macro concerns right now.
And just lastly, I take your point on the mega caps, but what are your thoughts on small caps compared to maybe larger caps?
Yeah, so the small caps were an important call for us going into this year and as part of this broadening playbook. But again, that's where we were fairly reliant on this soft landing, easier Fed scenario, which is now coming into question as 10-year yields back up. The line of sight towards future Fed eases is a bit more complicated right now. And then, the economic sensitivity of small cap is always sort of a given here. And so it sort of is the poster child for where you would expect to see a lot of the negative macro influences of the oil price read through related tariffs and other factors come to play. So we're essentially stepping to the sidelines on that small mid cap broadening call for now, hoping to revisit in the next couple of months.
Lindsay was speaking with Scott Kroner, head of U.S. equity strategy at Citi. Coming up, we'll see why one of the private credit players is being called the canary in the coal mine, what it signals for investors rushing for the exits. A father-son duo who rode the private credit boom are now facing a major stress test. Cliffwater's flagship fund is seeing redemption pressure that is raising fresh questions about risks in the multi-trillion-dollar private credit market. For more on this, let's bring in Ellen DeMoro from Bloomberg News. Ellen, thanks very much for joining us.
Thanks for having me.
All right, so Cliffwater, was this one of the first, and how big did it get? How many loans does it have out there?
Cliffwater has more than 4,000 loans in its interval fund. It's one of the first consultants turned asset managers in the market. It grew by partnering with various direct lenders across the market and getting a slice of each loan that those managers did, and that's how it was able to grow so quickly and have such a diversified fund.
And so it didn't have to do any sourcing or originating on their own. Were there no regs for this?
There's not. No, it's something that they sort of pioneered and that a lot of other consultants have sort of started doing as well across the market. It's really something we've seen emulated across the board, and we've also seen the interval fund product be something that a lot of other private credit managers have also begun to launch as well.
And so how spread out are they? How many? Where are their tentacles?
It's pretty far-reaching. They are with more than 50, I believe, direct lenders across the market. So they've got their hands in a lot of different pies, so to speak. They're invested in those funds, both as a limited partner, and then they invest alongside those funds in the direct loans themselves. So it's probably one of the more diversified products in private credit.
All right, and now we're seeing a spike in redemption request, I guess, right? Because you're not necessarily going to get the money. What's pushing that right now? Where's that pressure coming from?
A lot of that's coming from sentiment in the market. There's a lot of fears around artificial intelligence and how that's going to disrupt software. Software is the single biggest exposure, sector exposure in private credit right now. It's about 20%, which is pretty large. And there's just no way of knowing how many of these companies are going to fare well and how many are going to be completely disrupted by artificial intelligence. So we're seeing a big spike in redemptions across the board, not just at Cliffwater.
And so where does Cliffwater have the backing for this, or are they in trouble?
So far, they have enough liquidity to keep up with those redemptions. Our reporting shows that they'll be able to do this for at least a year at max redemptions without, selling any assets or any fund stakes or anything like that. So far, so good, but it sort of remains to be seen if this remains elevated for a long period of time.
And of course, investors, there's limit. They're really quite limited on what kind of recourse they have or what they can do about this. They just kind of have to sit and wait, don't they?
Yeah, I think everybody's waiting to see how things fare, how software does, and there's like a limited number of redemptions that they have to honor, so you can't just yank your money out at any time.
And now you mentioned how there's really no regs to oversee how they grew or where they grew or what they grew. Are we hearing talk of that coming in, or have they brought them in since, because was it 2006 they launched, or 2004?
2004, yeah. I haven't really seen any talk of regulation around consultants in particular, or this sort of model that Cliffwater has pioneered. We're seeing more legislators talk more about private credit and kind of question its interconnectedness with banks, its, sort of riskier sort of financial engineering that goes on and things like that. But so far, there really hasn't been any firm talk of regulation coming down the pike.
Okay, we'll wrap it up there. But Ellen, thanks very much for joining us with that. We appreciate it.
Thank you.
Bloomberg's Ellen DeMoro. Coming up, we'll put the spotlight back on CERAWeek, where our Bloomberg partners caught up with Canada's energy minister. More after the break. Hundreds of Algoma steelworkers have punched in for their final shift amid 1,000 layoffs tied to a switch to electric steelmaking. As employees navigate EI in a competitive job market, the city of Sault Ste. Marie is pursuing port funding, eyeing more than 2,400 jobs. CTV's Corey Nordstrom has more.
Hundreds of Algoma Steel employees had their final shift over the last 4 days, part of the 1,000 job cuts related to the company's early switch to electric steelmaking. Today, dozens took part in sessions to learn more about employment insurance.
I don't know if I'm going to get called back. I don't know if I'm going to go back to school, so at least get this on the go. If I stay on unemployment for a couple months, maybe I get something sooner than that. Just kind of get the ball rolling, at least set myself up for what's coming next, and then go from there.
Workers like Prevo are also stressed that their former colleagues are now competitors in the job market.
There was, from the one union, there's 900 people laid off and 150 from the other. Yeah, that's a lot of people you're competing against for a handful, maybe a little more than a handful of jobs, but there's only so many mines out there that are only going to hire so many people, and some people aren't going to get them.
The Port of Sault Ste. Marie is one way that City Council hopes to bring back jobs to the community. If the project receives funding from upper levels of government, it could operate over 2,400 jobs when fully functional in a few years' time.
The construction jobs would be 1,400 to 1,800, depending on when the work was being undertaken, almost immediately. And so that would be a good bridge for those 1,000 workers that are being laid off in the short term, if they were interested in construction style jobs for the port.
With those levels of government investing hundreds of millions of dollars into the company's transition to the electric arc furnace, Shoemaker says it's right that they be part of a solution to find those 1,000 workers a suitable job in a project that he believes will contribute to the region and country.
Federal government, provincial government can't simply allow that transition to see those jobs evaporate. It will not have been a success if that happens.
The city has already submitted funding applications for the port project and hope to hear back shortly after the April deadline. Corey Nordstrom, CTV News, Sault Ste. Marie.
Canada's energy minister, Tim Hodgson, says he has spoken to U.S. officials about shipping more natural gas to the U.S. for LNG export and to support AI data center demand. He spoke with Bloomberg's Julie Fine at CERAWeek in Houston.
The IEA says if you are a net importer of oil, you need to have reserves. Canada is a net exporter of reserves. So, for example, the United States, you're the biggest producer of oil in the world. You produce 12 to 13 million barrels per day, but you use 20. Let me be really clear. You produce 12 to 13, you use 20. 63% of that difference comes from Canada. Canada exported almost 4.5 million barrels to the United States last year. How we will do that is increase our net exports. We will do that by asking all of our producers to get to the maximum production they can and to delay turnarounds. As you may be well aware, many of the oil sands producers have to do turnarounds on their plants and facilities. We've asked our producers to delay those turnarounds so they can keep producing. Typically, a Canadian oil sands producer takes that turnaround time in Q2. Right now, we've asked them not to do that so that they can keep producing and sending oil both to the United States and also to our allies around the world. We ship over 1 million barrels a day to the West Coast. 60 to 70% of that oil goes to our allies in Japan, in Korea, and other parts of Asia.
Any pushback from your producers?
No. Canada, as I've said yesterday, Canada doesn't use energy for coercion. Canada uses energy as a unifying force. We want to help the United States make sure that those barrels keep flowing to the United States, and we want to help our allies around the world.
Can you detail any conversations you're having with the Trump administration about this during the war with Iran?
We had a wonderful conversation yesterday with Secretary Wright and Secretary Burgum about how we're doing everything we can to keep those barrels flowing. As I just talked about, we send almost 5 million barrels a day to the United States, also on natural gas. So the U.S. is exporting natural gas to the world right now. You export about 20 billion cubic feet a day. One of the reasons you can do that is you import 8 billion cubic feet a day from Canada. If you look at the Pacific Northwest, 90% of the gas the Pacific Northwest uses comes from Canada. If you look at Chicago, 40% of the gas in the Midwest comes from Canada. If you look at Northern California, over 40% of the gas that's burned in Northern California comes from Canada. We talked about how we could help send more gas down to help you export more off the Gulf Coast and to help you with your AI strategy. Obviously, a key component of winning the AI race is building more data centers. That requires more natural gas. We can provide that natural gas.
Do you feel you came to some agreements about that walking out of there?
We have a shared vision. We talked about Fortress North America. Look, our two countries are our best customers. We sell you lots of crude and natural gas. You sell us refined products. In Eastern Canada, you sell us gas from the Marcellus. We're stronger together than we are apart. And so we talked a lot about Fortress North America.
At a critical moment, allies, of course, in desperate need of oil, Canada's ability to supply it is limited by pipeline infrastructure. Let's talk about ongoing talks with Alberta. How much closer is Canada to construction on a new pipeline to the Pacific?
So we have what's called a memorandum of understanding with Alberta about how we move forward on that. As you know, we built a new pipeline to the West Coast, the TMX, that came on stream in 2024. We're already talking about expanding that pipeline. We built a natural gas pipeline to the West Coast, the Coastal Gas Link, which is now firing the only LNG plant on the west coast of North America, which is coming up to speed. That's really important for our allies. We have a series of discussions going on about another 1 million barrel pipeline to the West Coast, and we're heads down working on that, and we're confident we're going to get there.
On that pipeline, though, you've said that the government does not want to fund the new West Coast oil pipeline. Are you getting interest from the private sector?
So that pipeline, the proponent of that's going to be the government of Alberta. The government of Alberta is working with multiple different pipeline private sector companies right now. They're the proponent. They've said they'll be ready to come to us in June of this year with that proposal. And when they do, we'll evaluate it. And we have a shared goal of trying to help our allies get more oil.
Your government supports a new oil pipeline to Canada's west coast, but for that to happen, you've said that companies must build carbon capture in the oil sands. You've set that April 15th deadline. Do you think you'll meet it?
We are in intense discussions right now. I was talking with Premier Smith yesterday. I am confident we share a goal of building the biggest carbon capture project in the world. It's called the Pathways Project. It would take 16 million tons of carbon a year out of the atmosphere, and it would significantly reduce the carbon intensity of all of our barrels. When we do that, we have the ability to add millions of barrels a day of production and build that pipeline to the West Coast.
And that was Tim Hodgson, Canada's energy minister, speaking with Julie Fine of Bloomberg. Market Call is coming up next. Joining us today is Martin Cobb. He is Senior Vice President, Equities at Lawrence Steinberg Wealth Management. His focus, global and North American equities. Let's take a look and see how the markets are doing on Bay Street and on Wall Street. The rally continues on the TSX. Started off in the red, but it's up about 0.6%. A couple of the movers worth mentioning right now. Transcontinental, let's bring that in. The commercial printer of flyers, it's up about 10% after their reset. They rose yesterday and they're up again today after their reset and a special $20 payout on March 20th, a cash distribution. So they're up. That's why they're on a nice little rise right now. And one other one we want to take a look at quickly before we go, Dollarama. It is off, if we can bring that up. Dollarama's down on its missing on comp sales and a miss on its earnings report, so down about 7.6%. And Bay Street mostly, or Wall Street mostly in the red right now. Thanks for watching Morning Markets. We'll see you tomorrow.